Hello, everyone. I'm Matt Bloom. I'm here with my colleagues Josh Strauss, Bill Pekin, and our guest Nancy Davis for another episode of Managing Your Money. And today we're going to have Nancy talk to us a little bit about who she is, what she does, and the fund that she is running, and talk a little bit about tips, yield curve, all that sort of thing. So to get started, first, Nancy, thank you for joining us.
Thanks for having me on.
Of course. If you don't mind, could you just talk a little bit about, who you are and what you're doing, what your background is? Talk a little bit about the fund that you manage.
Sure. So I'm the founder of Quadratic Capital, and I'm the portfolio manager for the Quadratic Interest Rate Volatility and Inflation Hedge ETF. I know that's a bit of a mouthful. The ticker is IVOL, not eyeball. It's I like inflation or interest rate volatility. It's just a fix to TIPS alone. So it's mostly TIPS are a type of treasury bond. Stands for Treasury Inflation-Protected Securities. And it's sort of been a lifelong passion of mine. I've been running Quadratic for about 10 years, but prior to starting my own firm, I spent 10 years at Goldman Sachs, and it was right when the Treasury, I started my career when the Treasury Department issued TIPS. And I remember as a young trader thinking like, oh, this is these are sort of crazy because it's only CPI inflation, which is, it's just CPI is an index, right? Consumer price index. It's like nobody would buy the Dow Jones and say, ta-da, I have the equity market or the S&P or the Russell or the NASDAQ. Even the Fed is not using CPI, right? And then the other problem with TIPS is all TIPS are long duration. So being long duration, even strategies that say they're short duration are actually, it's kind of like almost a misnamed strategy because they're all bonds have duration. So a short duration strategy is really just like less long. It's not short anything. So we're trying to fix those problems and innovate, and we appreciate all of our investors' support in the product. And I think it's pretty different. There are not a lot of things out there that are actually different strategies. So it's been really a pleasure.
Yeah. So on this topic of tips, this is, I think, a type of security that not a lot of people really know that much about. It's, first of all, it hasn't existed for all that long, right? It's relative to nominal treasuries, they haven't been around that long, and they are kind of complicated. I think it's sort of like a dark corner of the fixed income market. Can you talk a little bit about like how tips should be used in a portfolio, sort of when they make sense to be used in a portfolio?
Yeah, definitely. So, as you mentioned, Matt, it's TIPS are pretty new. The TIPS or inflation protected bond markets, they only started in 1997. So a lot of people look back with back testing and they said, what worked in the 70s and 80s. And we like to grab people and say, look, the inflation markets are new. They didn't even exist back then. So looking at just, say cyclical equities or real estate or commodities or things that existed in the 70s and 80s is kind of missing the whole rates and inflation protected market. The other kind of tricky thing is they're not in a lot of these indices because the indices are really old. Like if you look at the AG index, right, the AGG, it's a really old index. It used to be, the Lehman AG for many years. Before that, it had other names, and it was the Barclays AG. Now it's the Bloomberg AG. And the AG has zero TIPS, no inflation protected bonds at all in the AG. And so a lot of people will just take us and add IVOL as a complement to that core fixed income to help diversify that bond portfolio.
Yeah. Okay. So just one more thing on tips. So we have had hot inflation over these last basically 2 years now, and yet just tips as an asset class haven't really performed very well, which is sort of counterintuitive, right? The whole idea is that you would get that performance during an inflationary period. So what's kind of behind that? Why did tips not perform well over the last couple of years, and what environment should be a tailwind to tips and IVOL even, in particular?
Yeah, no, definitely. I mean, this has been, the Fed switched from not even thinking about raising rates to hiking rates by, call it a little over 5% in a 12-month, I'm rounding 12-month period. And so that very aggressive sort of, kind of Volcker-esque Fed speak and actions caused real yields to move higher, and tips lose money when real yields move higher, and inflation expectations have fallen dramatically. So I think it's like all markets. There's the realized, which is what actually happens, and then there's implied, which is what's priced into the market. And so inflation expectations fell during the Fed's hiking cycle and real yields went higher. The yield curve also inverted because many investors thought, okay, the Fed is really aggressively hiking rates and the economy is not strong enough to withstand these hikes. So that caused the yield curve to have one of the biggest inversions, even more so than the late 80s during the last period of very high inflation. So it's been kind of a really, really wonky time because the Fed has, and the Fed didn't really touch their balance sheet. They've let a little bit of the balance sheet run off, about $1 trillion, but then they also had, the whole regional banking crisis around Silicon Valley Bank earlier this year in March, and they increased swap facilities, which had the effect of increasing the balance sheet even more. So it's definitely a really tricky time because you can, all strategies have, risks, all strategies have rewards, but inflation protected bonds on their own are pretty tricky because you have the duration exposure.
Right. Yeah, well, you touched on, the yield curve, and sort of the importance of that. Anybody who listens to financial news media has heard this, oh, we have an inverted yield curve, where the short in maturities are yielding higher than the longer in maturities. So, but go over again, why exactly do you believe that the yield curve is inverted? Why has it been inverted for so long? And what macro picture ultimately causes this to normalize and go back to an upward sloping curve, which is the sort of normal state of affairs? What gets us back there, and how does that work with what IVOL's doing? What are you doing within the fund that sort of accounts for how the yield curve moves?
Yeah, no, these are all great questions, Matt. So IVOL is most of the portfolio is just that type of treasury bond. So it's about, per prospectus, 80% is in cash and treasuries. We
Mhm.
use the inflation protected treasuries, and then we add interest rate options, which are long only products. We're buying interest rate options to kind of fix the issues with tips being it's only CPI inflation, and then all tips are long duration. And so we actually benefit from the, normalization of the yield curve. So right now it's still inverted. Today the twos, tens SOFR curve, which is what IVOL accesses, is negative 40 is the current spot rate. So if you just let's think about what does negative 40 mean. So this is the difference between the 2-year and the 10-year interest rate. And it's not normal to have an inverted curve because typically, Matt, if you think about it, you're lending money to the United States, in dollar format, right? You're like, here, Janet Yellen, let me give you money for 10 years versus 2 years, and you pay me less, right? That's not a normal situation.
Yeah.
But what happened was with the Fed hiking rates, many of the portfolios have gone into models, and a lot of the models assume the 10-year treasury is risk-free, right? And as we well know, no type of investment is risk-free. And treasuries, long dated treasuries, like in 2022, the 30-year treasury lost more in price terms than the NASDAQ, So it's been, I think a lot of people have just been kind of blinders on saying, I'm fearful of equities, therefore let's go run and buy duration as a hedge. But I think that's the really key thing is that, all investing involves risk, and treasuries are not risk-free, and they can absolutely lose money. And inflation-protected bonds in particular are pretty risky because there's no zero in the interest rate markets, right? It can go negative. The yield curve is very inverted. It's more inverted than it was. This period of inversion has been the longest period, in our lifetime. It's never been this inverted for this long. You can go back and look at Treasury data going all the way back to the 50s, and this period has been, over 365 days. And we did a white paper on this, kind of looking at historical inversions, but typically as the curve uninverts, that's typically an indicator that a recession is coming. It's usually with a lag, typically 3 to 6 months, but it's definitely a tricky time out there for investors. And I think that's where just being, using experts like your firm to help people with financial advice as fiduciaries is so important, because there's a lot of strategies out there, and it's important to be diversified.
And Matt, I wonder if I can, Nancy, I wonder if I can jump in just real quick, because this is such an important topic, and you're explaining it so well. Do you have a view on I'll put you on a hot seat a little bit. Do you have a view on how the curve uninverts? Do you think it's that the long end rises faster, or that the short end falls faster? Can you talk a little bit about that and how those different scenarios would impact IVOL?
Yeah, so the nice thing about the options is they are a spread trade. So it doesn't really matter how it uninverts, right? So it can uninvert. Right now, what's been happening, like since the Fed came out September 20th and said, kind of that messaging of higher for longer, the curve has bear steepened. So 10-year yields have moved higher than short dated yields. Mm-hmm. But it doesn't really matter how it happens. It can happen because 10-year yields go higher, or it could happen because the Fed actually decides to not, we still have a little bit of a hike probability priced in this year, if you can believe it. And if the Fed cuts rates, that's also beneficial. So it's either one. I think of it very similar to credit. Most investors add, outside of, there's two kind of main bond risks. There's duration risk, and then there's spread risk. And most people in fixed income, they add spread risk in credit, right? Like whether it's private credit, floating rate notes, levered loans, high yield bonds, investment grade bonds, all of those want credit spreads to tighten, right? They want tighter credit spreads, and credit spreads tend to widen when equities sell off, right? So you can say, oh, I have stocks and bonds and I'm diversified. But if you have a bunch of things with corporate beta, you're not really diversified, right? You have, because stocks, if you own, simple example, Apple stock and Apple bonds, you really have the same corporate beta. You just have different parts of the capital structure. So what we do with IVOL is interest rate spreads. It's just a different type of spread risk. So we want interest rate spreads to widen. And that can happen either because the Fed cuts rates, and the Fed typically cuts rates if something bad is happening, right? Like, Silicon Valley Bank week, the strategy had really good weekly performance because the market said, aha, the Fed is breaking the banking system, they're going to cut rates. Then after, kind of they came out and said nobody's going to have any losses on deposits, and everything, kind of those cuts went away. But that's, I think, the nice thing about the strategy is you're not taking a bet on, just one economic outcome. It could either be risk off, where the Fed cuts rates, or it could be more, stagflation or inflation expectations increasing with long end yields normalizing. So it's kind of the bonds that we own, the tips, they want lower real yields because they're inflation protected bonds, but the options don't really care about the level of rate. We just want the spread between rates to widen.
That's a really important point because so many strategies, as you talked about, have duration. There's always duration, but in a lot of strategies, if in this case the uninversion happens because the long end rises, that hurts a lot because duration gets extended, right? That hurts a lot of strategies. And what you're saying with IVOL structure is that wouldn't negatively impact you at all. You're kind of indifferent or agnostic between the short end and the long end, however it uninverts, as long as that spread, right? As long as that spread widens. Is that a fair statement?
Yeah, we also have exposure to volatility as well, which I think is worth spending a moment on. So there are kind of, I would say, three factors inside the fund. There's exposure to real yields from tips. There's exposure to the curve, and that's through the options, delta exposure, not to use jargon terms, but that's the sensitivity to the curve change. And then there's vol. This is not equity vol, it's actually interest rate volatility. But I think it's really important for people to understand that any place that you have the ag exposure or some of these core fixed income strategies, any place there's US mortgages, homeowners are long the option to prepay in our country. So any place you own mortgages, you're actually short vol in your fixed income fund. It's not equity vol, it's fixed income vol. But I think it's really important to understand that the Fed's balance sheet, about a third of it is mortgages. And, if you look at what happened with Silicon Valley Bank and you read their 10Q, their duration extended because homeowners are pretty rational and they didn't prepay as quickly. And so with the mortgage, you have to model all the different factors, but you have to model that prepayment risk, which is modeling basically series of short options. So what we are is we're a treasury obligation coupled with long options, where if you think about what's inside a mortgage, it's an agency obligation coupled with series of short options because homeowners are on the option to prepay. So that's the other, not to complicate things, but a lot of people will like to use IVOL as a complement to the ag to reduce that embedded short vol that exists in their bond portfolio.
Yeah,
so I have a question with regards to the action in the bond markets over the last, call it 60 to 90 days, where the 10-year has gone up, the yield on the 10-year has gone up considerably, and obviously, and the short end of the curve not so much. And with that, you're seeing increased volatility in the bond market measured by the MOVE index, and all these people are out there talking about term premium and this and that and reasons why this is. And for us, it just seems like, the world is just starting to realize that deficits and yields are finally starting to matter to investors and causing yields to rise. And I just wanted to hear your thoughts on why you think that volatility and the absolute level of 10-year has gone up so much so fast in the last 60 to 90 days.
Yeah, well, a lot of people have been, kind of not diversified. Like you guys have been very diversified, very thoughtful about these risks, but a lot of people are just sitting there with the kind of traditional 60-40 portfolio. And there's no guarantee that stocks and bonds will be negatively correlated, right? They can absolutely go down together. We saw that in
2022.
Yeah.
22, we saw that. And a period of stagflation is definitely, historically meant that stocks and bonds go from actually being negatively correlated to positively correlated. And there's a lot of leverage out there too in the market, whether, any place that people use linear derivatives like futures contracts, swap contracts, those are all linear derivatives that, I think about it like a credit card exposure where you put up a little bit of money and you get exposure to a lot more. And so there's a lot of leverage out there in the bond market, whether it's, CTAs or risk parity. A lot of investors have levered up. And so I think what you're seeing, this quick move, has been a deleveraging of even banks, they're marked to maturity typically. So when you have kind of like what happened with Silicon Valley, then when depositors want their money back, they actually have to sell their assets. And there's that, that kind of disconnect where you can have, real extension with duration. So especially because of mortgages, it's always mortgages. Like, all these kind of big blowups are always short volatility. And that's why it's nice to have strategies that are actually long volatility as well, because that, in a period of risk off, volatility tends to increase across, all asset classes, but not just the VIX gets lots of attention because it's equity vol and it's really easy to see, but people don't see the embedded short vol that's inside of mortgages.
Yeah, this is new territory for, I think, for a lot of people, and hopefully as they watch this conversation, they'll start to realize what's actually happening inside the guts of these securities.
Yeah, I think you just have to be careful with names because like the ag is sort of considered core fixed income, but like it's kind of crazy. Like, how can you have no inflation protected bonds in core fixed income? And how can you only be short volatility in core fixed income, right? So that's kind of the problem I know that you guys have solved in your client portfolios. And I think it's something that more advisors, more people should be thinking about, kind of these old indices that are in sort of name only and not relying just on the name and really understanding what's under the hood. Like even short duration strategies. There are a lot of short duration strategies out there that don't take a lot of interest rate risk, but they're all still long duration, right? They're just less long. And then a lot of them add, whether it's mortgage spread risk or credit spread risk. So you have some short duration strategies that they don't take a lot of interest rate risk. They're still long duration, but less long, but they add a lot of spread risk. And a lot of the credit is, triple B minus. Like some of these strategies have 50% of the exposure is triple B minus credit, or it uses a lot of structured credit, which is levered linear mortgages, right? Which are, it's like taking short vol and amping it up. So it's really important to be diversified and to look under the hood, not just go by name only. Like short duration doesn't mean not risky. It just means you have to look at, if it's all governments, it's typically fine. But if you have a short duration portfolio with a lot of structured credit, which is anytime you see the 3-letter acronyms, that's structured credit, or has a lot of corporate credit spread risk, or EM, it's a tricky time because a lot of people kind of close their eyes. I know you guys don't, you're very under the hood and deep in the weeds, but some people just use these models that are old indices, and it makes no sense to have market cap weighted in fixed income, right? It's like that's an equity concept. So it's like a lot of these indices in the QE era have just changed like distorted their composition.
Being market weighted in fixed income means that you're overweight the most levered companies out there, right? Which is just a little bit insane to us. I mean, it feels to us. Look, we've had a 40-year bull market in bonds that ended, in my view, during COVID. When the 10-year hit 0.5%, and I think we're off to the races, to use I guess a reverse term, for a multi-year bear market in bonds, and it's got investors who don't necessarily want equity risk, and IVOL is a good place to get some non-equity risk and not take on material duration and no credit risk, right? But I guess where I'm going with this is, how does this end up playing out 5 years from now? I mean, are we going to see? Do you think the whole level of the yield curve will still be upward sloping, and we're looking at like 7 or 8 handle on the 10-year and a 3 handle on the short end? I mean, how do you think things play out over the next 3 to 5 years?
Definitely it's tough to predict 3 to 5 years out, but I think the one thing that I can say is the strategy isn't more of the same, right? It's something different. It's something that most people don't typically have exposure to, which is the rates market. So it's something that can definitely, you don't need a tail event, right, to normalize the yield curve. If you go back over the history of financial markets, most of the time it's upward sloping, which is just normal, right? It's not like if we had some kind of, stagflation. I think, IVOL obviously didn't exist, neither did TIPS during the last period of stagflation in this country. But I kind of think, if you look at the three factors within the fund, I think interest rate volatility would be a lot higher as models switch to have stocks and bonds become even less negative, would be a deleveraging, right? Imagine if they flip to be positively correlated. So I think it would be bullish for vol. I think TIPS would outperform credit and nominal bonds in a stagflationary environment. And I think the yield curve would steepen, probably initially from the Fed cutting rates because of a weak economy, but then also from the rest of the world owning, financing our debt, right? The fiscal situation is pretty dire. The Treasury has about a third of their debt coming due just in the next year, right? That's pretty staggering. And 30% of our debt is owned by foreigners. So, there are a lot of environments where you don't necessarily need a tail event to happen to have the strategy be beneficial, just like a more normal environment would be good. But there are tail events like stagflation or kind of the Fed cutting rates because of a risk-off environment that could also be beneficial. So I like it a lot because you're not having to take a bet about one specific macro environment. If you think about, if we compare it to like, say, investment grade credit, right? There's only two ways investment grade credit makes money. A, yields lower, and B, credit spreads tighter, right? So that's sort of a one environment that's worked well for a while, but you have to question, is it worth only having those types of strategies in your portfolio, or is it better to have more diversification, what like you guys are doing inside of your portfolio?
Well, this is pretty fascinating stuff, and like I said, I think this is stuff that's probably going to be pretty illuminating for your your typical investor who may already be familiar with tips, but may not really understand the nuances of what's really happening in these rates markets. And I think there's a lot of misunderstandings about what's in the indices and how all of this stuff actually works that you've been explaining. So this is fantastic. Billy, Josh, either one of you have any other questions for Nancy?
No, I'll just maybe just more of a comment, just thinking about what Nancy's been saying. And I think and Josh commented, we've, had 40 years of a never-ending bond bull market that probably has ended. And if you think that these bond bull and bear markets seem to go in 30 to 40-year trends or cycles. So if you think that we are now at the start of another long cycle, it's been hard to find places in the fixed income realm to make money, as we now are in, I think, an unprecedented third year in a row of the ag being negative this year, which I don't think has happened in many years, maybe ever, but at least in the last 50 years. I think investors need to look harder to find solutions in fixed income. And I think IVOL is one of those places outside of short-term tips, short-term treasuries, nominal treasuries, which we've put most of our client money, as well as short-term tips. I think it deserves a place in our client portfolios.
Agreed. Some favorable tax treatment there, right? I know we've discussed this before, Nancy, that the IVOL gets a little tax benefit from the options, right?
Yeah, so ETFs, everybody always talks about ETFs being so tax efficient, and we're really utilizing that technology of ETFs being more tax efficient inside the funds. So we actually access our tips via a passive Bloomberg index. So we've done all of our bond trading in kind. And by doing that, we've avoided, IVOL hasn't had capital gains tax in over 4 years because we do our treasury trading in kind, which is beneficial to our shareholders. And then the options are taxed as ordinary assets. And so just mathematically, half of the world's options, I'm picking an approximation, let's call it 50%, expire worthless, right? They don't end up in the money. And so we thought it was very beneficial to, kind of create the structure inside of an ETF to benefit from that sort of natural, it's like exfoliating your skin, there's this natural runoff of the options. And as options expire worthless or we sell them for a loss, they actually generate negative ordinary income because they're ordinary assets. And that can potentially offset the interest income that the tips are paying. So if you look at your, I own IVOL personally. In my brokerage statement from my 1099 for 2022, 100% of that 30 basis points every month was taxed as return of capital, meaning no capital gains, no ordinary income tax because of that unique tax treatment because the yield curve was so inverted. And so obviously 2023 is not over yet, but I would expect we would also have no income tax on the tips yield again this year because of the inversion of the curve. So it's kind of a nice tax treatment to have because ordinary short-term capital gains are taxed at ordinary as well. So it's kind of a neutral on the upside, but it's a benefit if the options do not work. And as they can generate negative ordinary income, which can offset the interest income from the tips. Hopefully,
the next time I get
I'm not a tax advisor.
I'm gonna be thinking about IVOL. The next time I get a facial, I'm going to think about IVOL and my exfoliation of my face and the options. So I appreciate the analogy.
I've never thought about the two things in that way before, but
I know.
There you go.
That was definitely a creative thought, but I don't know. It's a
Sure.
reasonable metaphor, right?
Good visualization. Yeah.
Works.
Yeah.
Right.
Okay, well, I think that probably wraps it up. You've certainly provided a lot of valuable material and education here today, Nancy, and we appreciate it. So once again, thank you to Nancy Davis, who is the manager of IVOL, IVOL, if you're interested in that. And thank you again, Josh and Billy. This has been another episode of Managing Your Money, and we will see you next time. Thanks a lot.